Okay, let's get started on chapter 6. Like I said, we've got some extra time on this chapter, but it's because there's extra stuff in it. So I really think this should be 2 chapters. I think there should be a completely separate chapter for depreciation. That's not how the author set it up, though, but so that's why I try to bake in some extra time for this chapter to treat it as though we have 2 chapters here instead of just 1. So at chapter 6, we are talking about a couple of new forms. Actually, several new forms. First off, we're going to talk about the Schedule C. So we talked about Schedule A, we used for itemized deductions. Schedule B was to itemize out our interest and dividend income. Schedule C is income from sole proprietorship. This is a business that is owned by one person and has chosen not to incorporate or become a corporation. You can be a single owner of a business and still choose to incorporate if you want to do so. Usually that's done with an S-Corp organization, and we'll talk about that a little bit more when we get to chapter 15. But for this chapter, we're not talking about a corporation. We're just talking about a sole proprietorship. Along with the Schedule C, which we're going to talk about how we fill that out, we also have, as I mentioned here, so Schedule C flows to line 3 of Schedule 1. If you were to pull up a Schedule 1 and look at that on line 3 of that form, that's under other income. So it would be income from, I don't know how it's worded, income from a sole proprietorship or income from a Schedule C. But if you hear the term Schedule C business, this is what we're talking about. Individuals can have multiple Schedule Cs with their tax return if they have multiple sole proprietorship businesses. Maybe somebody owns a bakery and then they also have a accounting business on the side. They're a bookkeeper and they do bookkeeping on the side. So they've got 2 businesses. If they're the only person providing that they're the only owners of that business, each of those businesses, they would have 2 Schedule Cs on their tax return, and then the income would then bleed into the 1040 and would be taxed in that manner. Now, just because you're a sole proprietor, we're talking about ownership here. You can still have employees as a sole proprietor. You can pay other people to perform services for you and provide W-2 forms for them and do all the things that an employer does. You can be an employer as an owner of a Schedule C, but what we're talking about here is the ownership of the business is only one person. If more than one person owns the business, you cannot report it on a Schedule C. It is no longer a sole proprietorship. It would be then by default a partnership and would have to be reported on its own tax return, a partnership tax return, which we're going to talk about in chapter 14.
Guessing it would still be the partnership if it was like a husband and wife, because there was one tax return. Like that would be
still a partnership. Okay. Yep. So, and there are some, and I'll show you when we go through and look at the Schedule C, there's, well, actually it's with the rental income, there's a special classification where you can choose to treat it as though it's one person. Otherwise, you've got 2 that you've got to do. But if it's owned by a husband and wife, that's 2 people, you've got to file a partnership return for that business. So again, this is only for one person owned by one individual, a Schedule C. There's some other forms that we're going to look at in here as well that relate to, so the main form that we're talking about is this Schedule C. It's like an income statement. So that's how it's set up. You got your income. There's also a place for cost of goods sold. If you sell products and you have inventory, you would have to calculate the cost of goods sold. And then there's a place for all of the expenses as well. So it works like an income statement for sole proprietorships. So within that, we are going to talk about, so in these learning objectives, and I'm hoping, let's see, we've got 50 minutes. I'm hoping that we can get started here on the third learning objective because I'd like to get started in talking about depreciation. Depreciation for tax purposes is completely different from depreciation for financial accounting purposes. So I'm going to ask you to kind of set aside everything you've learned, all your straight line depreciation or some of the year's digits depreciation or accelerated double declining balance depreciation, all that stuff. Set that aside because how it's done for tax purposes is different from how it's done for financial accounting purposes. We're going to talk about, before we talk about depreciation though, we're going to talk about how income is recognized and reported. We've already talked about that a bit, kind of got a little bit of a handle on the cash basis for accounting because all of this as well is, it's reported on the cash basis. We're not doing it on accrual basis. So any accounts receivable that would show up on a financial income statement and be included as income on that financial income statement would not be included as income on our tax sole proprietorship income statement. Any expenses, any prepaid expenses, we wouldn't expense them for financial accounting purposes yet, right? Because it's a prepaid. We haven't actually used the expense yet. It's not matched with the period in which it's being used. But if we've paid it, we're on a cash basis for tax purposes, so we are going to record it as a deductible expense on our tax return. So the financial statements, 9 times out of 10, are going to differ from what's on the tax return. And we've got these tax book differences. We're going to go through that a little bit more in more detail in chapter 15, but I just want to kind of give you a preview of that and just the fact that it's going to look different from financial statement. We're going to talk about ordinary and necessary. We already alluded to this when we were talking about the educator expenses, I think it was, that they have to be ordinary and necessary. So we'll kind of revisit that. And then depreciation, this is going to take us a little while to go through all of the different factors that are involved in calculating depreciation for tax purposes. We're also going to talk about travel. I don't know why they even say entertainment expenses anymore. Entertainment expenses aren't deductible, but I guess they're still referring to them as travel and entertainment expenses. Travel expenses and the rules surrounding what can be deducted for travel. The rules for deducting the business portion of a residence and business bad debts. So business portion, this is the home office deduction. Home office deduction only applies to individuals who are self-employed. So you can't, if you're just a W-2 employee and you work from home, you cannot deduct any of the expenses associated with that income because you're a W-2 employee. That was one of those miscellaneous itemized deductions that I just talked about a little bit that was taken away. But if you are self-employed and you work at home, then you can deduct some of those expenses that would be otherwise personal expenses. For if you were just using the home for your own personal purposes. Now, if you're using it for business, you can treat that portion like it's a business expense. So we're going to talk about how we do that. Business bad debts, that's a very short conversation because we're on a cash basis, which means we've never included in income accounts receivable. It would only be accounts receivable that are then not collected that would be a business bad debt, right? So because we're on a cash basis, usually for sole proprietorships, there is no such thing as a business bad debt expense that you get to deduct. We're going to talk as well about hobby loss rules. The reason we put this in here is because oftentimes it's hard to make that distinction between, is something a hobby or is it a business? You think about all those farmers market stalls that people have. If they're just doing that kind of on the side and they do it because they enjoy it, it's grandma crocheting her little hot pots and stuff like that, and she does it, and so she goes down to the farmers market on Saturday and tries to sell a few of them. Well, is that really a business or is it a hobby? There are different tax rules for how income from those two activities are treated, and so it's important to know the distinction between that, as well as education expenses, and then self-employment taxes. So in payroll, we talked about, most of you have taken payroll. We talked a little bit about self-employment taxes. We're going to talk more about that here. And there's a couple of little differences from what we learn in, a little additional nuances to that than what we learned in payroll class. So those are the main things that we are going to talk about in this chapter. It's a big chapter. So yeah, let's